So now for our main topic of episode 129 of the Security Token Show, we're talking about Wall Street, which is officially betting on tokenization, Kyle. I think that's pretty big news given the fact that we've been doing this show for almost 3 years now, and we very everly get to talk about the fact that Wall Street itself, the major old guard, if you will, is actually taking advantage of this technology, proof that the industry is headed towards tokenization, and we can officially call it is happening, folks.
Yeah, no, let's take a look at the timeline, right? If we take a couple steps back. When the security token space first came out, this is when we were working in the space, 2017, 2018, crypto was at an all-time high, everyone's freaking out, and it still felt like this was a total offshoot. I think that for a long time, it took everyone in the industry a while to figure out the regulations and where all these pieces fit in, how blockchain would actually transform capital markets. But the first move, in my opinion, that really drove some more institutional Wall Street spotlight was Overstock. Overstock not only was a big owner of T0 and a proponent of cryptocurrency transactions, but they issued a digital dividend to public shareholders that was sold as a security token. So if you owned 10 shares of the public stock, you got one extra share that was a security token only able to trade on T0. And for the first time, this forced institutions, large shareholders, and just traditional people to actually accept what a security token was and understand how the industry worked. And from there, we've seen cascading effects of additional adoption happening moving forward. You see INX having their publicly registered offering, their IPO as they call it, and many other things coming in. But that was kind of the first movements in this industry. Now we certainly see it in progressing much more.
Indeed. I think that was just sort of the, almost new guard, if you will, scratching at the surface, trying to say, look, we don't like what's going on here. Overstock said we see a better way for our securities to get settled and for us to interact with our shareholders, and to give it to Dr. Patrick Byrne. He had that vision way back then. And now we're actually starting to see the old guard. We're talking about the Morgan Stanleys, the Goldman Sachs, the NASDAQs, and as we just talked about in this episode, ICE, one of the biggest exchange companies in the world, is officially moving forward into tokenization. And so I think you're right. We have to recognize that a few years ago, the reality was this technology was brand new, it was unproven, and the crypto markets were very excited about everything else that was going on. There was a moment in the sun, let's call it, where security tokens and the concept of tokenizing assets got everyone very excited. But the problem was the infrastructure wasn't built back then. You can't just launch a cryptocurrency exchange and suddenly start getting users and listing tokens. You need to be regulated. You need to operate and have licenses, and you need to have an entire compliance department and staff in order to support the underlying technology that actually does enable all of this trading in the first place. So that was a pretty big deal because, of course, as security tokens fizzled out, they were kind of, cast aside, if you will, except for us. We were, of course, have never wavered.
No, we have not.
And now we believe it's coming into fruition because, as we've seen the ICE invest in T0. We've seen Morgan Stanley invest in Securitize. We know that ICE also invested into Tokeny, and we know that NASDAQ, Goldman Sachs, and even JPM, they've all played around with blockchain as well as are looking at tokenization services. So even though, they're kind of like sleeping giants, they are certainly not asleep at the wheel, if you will.
I think there were a couple key reasons that have really helped spur the development of the blockchain for capital markets movement. Certainly, we've talked about it here on the show before, but Wall Street bets and the entire movement around GameStop, AMC, BlackBerry, all of these crazy shorted stocks that did seem to have some really, I don't want to say sketchy, but some complicated market mechanics that were going on around, outstanding short positions being higher than the total outstanding shares, and potentially some movements in those clearing and settlement firms that were causing some issues on the public markets that really started to awaken people to this idea that the traditional plumbing that all of our markets are built on from the 80s and the 70s, that's 40, 50 years ago now, people.
That's a long time.
That's not built for the high frequency trading, the digital trading movement that we have now, all of this fractional, seconds of investing between these assets, as well as international trading, which is much more accessible today than it ever was back then. It's really started to show some of the cracks in the system. Then, not to mention the T+2 settlement time, having multiple days of settlement has really caused some serious issues in the traditional public markets because of the fact that things move so quickly.
And then you marry that with securities law that's even 80 or years or older, and you've got a heck of a problem. You might think that indeed security tokens would be dead on arrival, but no. In fact, now through ICE's investment in T0, they also have exposure to the BSTX, the Boston Security Token Exchange, which also was recently greenlit by the SEC, acknowledging that they may be able to leverage T+1 or even T0 settlement time for now a national exchange, the first of its kind, as far as we know, really around the world, that has been approved by regulators endorsing this blockchain technology. And hopefully very soon, we're going to see them start to list assets, but they still need to go through some more kinks. But the point is, and that's kind of what we're saying here, is this doesn't move overnight. All of this takes time. They want to see the technology working. They want to see case studies be performed. They want to see trials be performed by big banks and such. But make no mistake, investments are happening. The banks are actively participating in this space. And I think almost over 2 years ago now, we recognized that almost 50 different banks of the top 100 largest banks in the world were somehow leveraging blockchain technology in some kind of trial or some kind of use case. I bet that number is even bigger now, Kyle.
Yeah, no, unequivocally, right? As we've seen how things have changed since the pandemic and what has really caused the international transfer of assets in a non-personal way. Now we're all digital. Everyone's talking internationally. Digitally, we need to have a digital accountability system as well. So I'm sure, and as we've even seen from just the Fed adopting CBDCs and exploring all these different pieces, this is something we would have never expected even just a couple of years ago. And now we see it happening in a very public way, in which the Fed is poaching literal private central bank digital or stablecoin issuers and poaching their employees to join the project. So we've seen a lot of that, as well as not only do you have the old guard from an institutional perspective, but you have the regulators themselves that are looking to embrace some of these things. We've seen, as we said, the Fed come out and say that they're exploring central bank digital currency projects. We've seen Gary Gensler say that blockchain and cryptocurrencies are not necessarily, illegal. They just need to follow securities laws, right? Like, it's not that we can't have them. It's not that they shouldn't exist. It's that they need to follow securities laws. As long as we do that, we can find ways to make it work. You've also seen other regulators around the world embracing digital securities and what that could mean for the markets, and seeing the regulatory approval and movement there, even in the SEC coming out and giving ATS regulations around custody of digital securities. There's been a lot of examples of regulators actually being relatively progressive in a way that we haven't seen in years past.
And without the regulators being progressive, Wall Street won't even take a look. So that's a big combination of events that's happening here. We might see a lot of what's happened in previous history as Wall Street starts to get more of its arms and roots into the various startups and the various security token ecosystem. We might even start to see some roll-ups and some acquisitions in the future. But you heard it here first, folks. Wall Street is paying attention to security tokens. They are absolutely investing in it, and they will be using it, not tomorrow, but very, very soon in the next few years. So with that, Kyle, any parting thoughts?
Well, I think you got to go to newsletter.stomarket.com, because there you're going to find our What's Drippin' newsletter, which is the best place to get more information around what's going on in the industry. We've got another newsletter that we just launched through Security Token Advisors. You can also check, if you go to the link in the description or link in bio, you can find out more information about that. That's a little bit more institutional information around what's going on in the space. And of course, you can follow us anywhere on social media to get more information. Herwig and I are always available if you want to reach out on LinkedIn or Twitter. But you can also follow STO Market to get all of the updates on everything going on. And of course, go to stomarket.com to find out information about which tokens are trading and how they're performing.
We're everywhere. Come connect with us. We're also on Discord. Come join the community. We've got lots of cool stuff going on. And with that, that's episode 129. Hope to catch you next Monday. Happy tokenizing.